Today's video, we will dive deep into the latest development shaking the global market and what they mean for India. With the US market crashing amid rising inflation, aggressive rate hikes, and unpredictable global events, there's a growing concern that the Indian markets could open lower on Monday. A potential gap down that may send ripples across our indices. Here's what we will cover in today's episode. First, we will see US market crash explained. We'll look at the factors behind the recent plunge in major US indices, including the role of rising inflation and aggressive monetary policy. Second, the Trump's effect. We'll discuss how President Trump's erratic policy signals have contributed to market uncertainty and investors' anxiety overseas. Third, FII outflow. With foreign institutional investors pulling out of the Indian market, we will analyze how this trend is linked to the global economic turmoil and where these funds are being redirected. Fourth, asset comparison. We'll visualize the comparison with a highlight from how US bonds offering lower but more stable returns stack up against the more volatile yet higher yielding Indian equities. And last but not least, impact on Indian indices. Finally, we will explore how these global factors could trigger a gap down on Monday, affecting key benchmarks like Nifty and Banknifty, what that might look like and what it could mean for investors. Recently, the US stock market have experienced a significant crash. Major indices like Dow Jones, S&P 500 and Nasdaq have seen a steep decline. This downturn has been largely driven by concern over rising inflation, aggressive interest rate hike by the Federal Reserve, and uncertainty about the global economic recovery. While these developments are happening overseas, they are not without impact here in India. Many foreign investors who traditionally put their money into our markets are rethinking their positions in light of the US slowdown. As a result, you might notice increased volatility in Indian stock market as well. Major indices like Dow Jones, S&P 500 and Nasdaq have experienced a steep decline. Several factors have contributed to create this slowdown. First, rising inflation and interest rate concern. Recent data has shown that inflation is rising faster than expected in the US. In response, the Federal Reserve has signaled that it will continue its aggressive interest rate hike to control inflation. These measures have rattled investors as higher rates often slow down economic growth and reduce corporate earnings. Second, shifting investor sentiment. With inflation on the rise and economic growth appearing to slow, investors' confidence have taken a hit. Many investors have shifted their funds away from riskier assets towards a safer investment, triggering a domino effect of selling across the board. Third, global economic uncertainty. The uncertainty isn't limited to domestic factors. Global issues including lingering effects from recent supply chain disruption and geopolitical tensions have compounded the situation, leading to increased volatility in the US market. Fourth, impact on corporate performance. Adding to these challenges, several high-profile companies have reported earnings that fell short of expectations. This has deepened concern over the broader health of the economy, further driving down market values. In summary, the crash in the US market has been driven by mix of rising inflation and aggressive monetary policies response, investor uncertainty and disappointing corporate earnings. As these factors continue to evolve, both US and global markets remain on high alert, and President Trump is contributing to current market uncertainty. During his tenure, President Trump implemented policies and made statements that often unsettled investors. His aggressive trade policies such as imposing tariff on key trading partners and renegotiating international trade deals created significant concern about global economic stability. These measures, while aimed at protecting domestic industries, led to heightened volatility in the market. Furthermore, his erratic statement further heightened investors' apprehension. Sudden policy shift and bold statement often left market scrambling to assess the potential impact on corporate earnings and economic growth. This unpredictability contributed to a lingering sense of uncertainty that continues to affect market sentiment even today. For Indian investors, these developments mean that shifts in the US market can have a ripple effect on our own financial environment. Since taking office, President Trump initiated a wide range of actions and policies across various domains. While it's impossible to cover every single action, here's an overview of some of the most significant measures he has implemented during his tenure. First is domestic policies and economic action, then immigration policy, foreign policy initiative. This is very, very important. First, he withdraw from international agreement. US withdraw from the Paris Climate Agreement, arguing that it disadvantaged American workers. Pulled out of Iran nuclear deal, citing concern over Iran's regional activity. Second, trade and economic policy, renegotiating trade deals such as replacing NAFTA with the United States, Mexico, Canada agreement. Initiated a trade war with China by imposing a tariff on wide range of goods to address a trade imbalance and intellectual property concern. Third is diplomacy and global engagement. Held a historic summit with the North Korean leader, and it was unprecedented move to engage directly with the isolated regime, pressured the traditional allies, including NATO members, to increase their defense spending while questioning the value of multilateral alliance. So there are lots of things in terms of executive orders, from judicial appointment, health and social crisis management, and other notable aspect includes executive orders and communication. Trump frequently used executive orders to implement policies quickly, often bypassing traditional legislative process. He also leveraged social media as a direct communication tool, which both energized his base and stirred controversy. Impeachment proceeding. His presidency was marked by unprecedented political battle, including two impeachment by the House of Representatives, though he was acquitted by the Senate on both occasions. These actions collectively transformed many facets of US policy and governance, influencing debates on economic strategy, immigration, international relationship, and more, with effect that continued to felt both domestically and internationally. President Trump's policy, while primarily focused on United States, have set off a series of global ripple effects that also impact India. Here are the key channels through which his action can affect the Indian economy and the markets. First is global market volatility. Trump's aggressive trade policies and unpredictable rhetoric contributed to increased uncertainty in global market. This volatility often leads investors to adopt a risk-averse stance, which can result in capital outflow from emerging markets like India. This phenomena is evident in the recent trend of FIIs pulling fund out of Indian equity. Second is trade dynamic and supply chain. The trade war initiated by his administration, particularly with China, have reshaped global supply chain. While this created a short-term instability, it also opened potential opportunities for India as companies look for alternative manufacturing hub. However, the overall uncertainty can dampen global demand, indirectly impacting Indian export. And third is impact on investor sentiment. The uncertainty and global economic stress triggered by policies such as imposition of tariff and withdrawal from key international agreements have undermined investors' confidence worldwide. This not only pressures US market but also sets off chain reaction affecting global indices, including India's Nifty and Banknifty. A negative sentiment abroad can contribute to a gap down at the Indian markets as the Indian markets open, as foreign investments may quickly withdraw in response to sudden market shift. And last but not least, currency and inflation pressure. The market volatility and shifting capital flow can lead to fluctuation in currency values. A weakening rupee can in turn lead to higher import costs and inflationary pressure within India, affecting both consumers and businesses. In summary, while some of Trump's policy might have created opening for India, the broader effect of global uncertainty, capital outflow, and reduced investors' confidence tend to pose risk. Indian market may face challenges such as a gap down on Monday if these global concerns persist, impacting key benchmarks like Nifty and Banknifty. Now we will move to FIIs. FIIs pulling out of Indian market can be seen as a spillover effect of the US market turmoil. The volatile environment in US, fueled in part by erratic policy statement and unpredictable rhetoric, has led global investors to reassess their risk exposure. With uncertainty rising on Wall Street, many FIIs are now redirecting their investment to what they perceive as safer asset, causing capital to flow out of emerging markets like India. This interconnected highlights how a downturn in one major economy can trigger a chain reaction, impacting investors' confidence and market stability worldwide. This is a sample bar. Whatever you are seeing is a sample bar chart that compares the average annual return of US bond versus Indian equities. Please note that the numbers used here are illustrative. US bond approximately gives 3% per annum. Indian equities on the other side approximately gives 8% per annum. This simple graph demonstrates that while US bonds tend to offer lower but more stable return, Indian equity, though historically offering higher returns, come with a greater volatility. Investors often shift to the safety of US bonds during period of global uncertainty, as seen recently. We have walked you through all the critical points, from the global market turbulence triggered by the US economic policy and unpredictable signals from Trump to FII's outflow affecting our domestic markets, and even a comparison of asset performance between US bonds and Indian equities. Now, all these factors set the stage for what could happen when Indian markets open tomorrow. In our next segment, we'll focus on the potential impact on Nifty and Bank Nifty. We'll explore whether these indices might experience a gap down at the open, what technical levels to watch, and how the lingering global uncertainty might shape the day's trading. We are currently looking at a Nifty 50 on the 1 hour time frame. As you can see, the index has been respecting a clear descending channel marked by two parallel trend lines. This highlights the ongoing bearish sentiment with the consistent lower highs and lower lows guiding the market south. As of now, Nifty is trading at around 22,764, down by 0.20% on the day. Let's break down on the day. Now let's break down the critical points and see what could be the next for index. Right. First, let's talk about the market structure. Notice the repeated CHOCH or change of character and BOS break of structure labels on the chart. We see an early CHOCH in December, signaling the initial shift towards bearishness. Multiple BOS points followed, confirming the downtrend with lower lows. Another CHOCH occurred in late January, hinting at a potential short-term reversal, but the bears regained control, leading to more break of structure markers. Right, this back and forth highlights the volatility, but the broader trend remains bearish within the channel. Now let's zoom into the key supply and demand zone. Order block, you can see these red zone mark areas where significant institutional selling took place. Notably, we have 1 hour order block around 23,800 levels and another closer at 23,200. Price reacted sharply at these levels, confirming them as a strong resistance zone. Fair value gaps, FVG, these gaps highlighted in red represents inefficiencies where price could return from vegetation. The recent FVG near the 23,200 The 23,200 zone acted as a magnet before sellers stepped in again. So if Nifty were to attempt another push higher, expect resistance at these order block and fair value gap levels. Volume analysis adds another layer to this picture. The chart highlights that 1.129 million shares traded are around recent order block, accounting for 72% of range liquidity, indicating heavy sellers interest. Similarly, the upper order block saw 149 million traded, reinforcing it as a major rejection point. Currently, Nifty has just broken below a recent break of structure around 22,800, and the bearish momentum seems to be carrying forward. The price is also hugging the lower end of the fair value gap, which could either lead to a bounce or further breakdown. So what's next for Nifty 50 bullish scenario? If bulls can hold the support near 22,700, we might see a retest of 23,200 order block on FVG zone. A breakout above this could trigger a test of upper channel line near 23,600, and second is bearish scenario. However, if bears maintain control and break down 22,700, Nifty could slide towards the lower channel boundary, possibly testing 21,800 to 21,900 levels. Given the current bearish momentum, the downside remains more probable, but always trade with the confirmation. A few trading tips based on this setup: intraday traders could look for shorting opportunities near OB zone with tight stop loss. Swing traders might wait for a potential bounce from lower channel or a confirmed breakdown for a deeper downside plays. Always watch for volume spikes around key levels for validation. Now let's break down the Banknifty index with index. We are analyzing Banknifty on 1 hour time frame, and as you can see, it's been quite a volatile, right? Currently the index is trading at around 48,900, down by 0.20% today, but there is a lot more going on here. Banknifty has been respecting clear supply and demand zone with several breaks of structure and change of character moments, giving us insight into possible future movement. Let's start with the market structure and key turning points, which is break of structure and change of character. We saw a change of character early on, followed by a strong break of structure that triggered a significant downturn in late December 2024. Multiple change of character points later hinted at short-term recoveries, but the broader structure remained bearish. A strong break of structure around mid-January confirmed bearish dominance before Banknifty attempted a short-lived recovery in February. The back-and-forth action reflects volatility, but structural breaks continue to favor bears. Next, let's break down the order block OB. These are the key areas where institutional buying or selling looks placed. Supply zone at the top, there's a massive 1 hour order block around 51,600 mark with 161 million volume, accounting for 34% liquidity. A strong resistance zone closer to the current price. Another OB sits around 50,400 with a 80 million traded, where the price faced rejection recently. A smaller but high volume OB at around 49,800 also acted as a key reversal point. Demand zone. On the lower side, the major demand zone is around 47,900, 48,300 with a notable 138 million traded, making this a critical support zone. These OBs are magnet for price action, so expect high volatility when Banknifty approaches them. Volume is a trader's best friend, and here's what it is telling us: the highest liquidity sits in the upper order block zone, indicating heavy institutional selling around 51,600 and 50,400. The 138 million volume in the demand zone around 48,000 shows buyers stepping in aggressively. In the past, and this could act as a strong bounce zone if the market pulls back further. Price action is currently hovering around supply and demand zone, a classical consolidation phase before the next move. Now let's map out the potential move for Bank Nifty. Bullish scenario: if Bank Nifty can hold above 48,800 levels and break past the 49,800 order block, we could see a run towards the 50,400 supply zone. A break out above that could test the 51,600 major resistance, but that's a stretch unless there's a strong catalyst. That's what we have to understand. And bearish scenario: if price falls to reclaim 49,800 and sellers maintain a pressure, drop towards 48,000 demand zone seems likely. A breakdown below 47,900 could uh, take the fall towards 47,200 to 47,000 levels, with current momentum leaning slightly bearish. Bearish, cautious long positions are advised unless we see a strong breakout. So how can you trade the setup? Intraday traders look for short-term positions near 49,800 or 50,400. OBs with the tight stop loss, scalp long positions if price respects the 48,000 demand zone. Swing traders wait for clear breakout above 49,800 or a breakdown below 48,000 for multi-day plays, right? Always aim for at least a 1:2 risk to reward ratio when trading within supply and demand zone. And that's a end of today's analysis. What you take, what's your take? Are you heading for a bullish breakout, or will the bears drag us lower? Let us know in the comment section below. Thank you for watching this video. I'll see you in yet another video. Till then, take care. Bye.